Okay, folks, I think it's given a few minutes to let people get up here. Welcome to Parallel Session 3, and just checking in the right room. This is the session on tax transparency and tackling the power of the bank lobby. My name's Dave Watson. I'm the Head of Bargaining Campaigns at Unison Scotland, and I'm the chair for this session. On the schedule we have 4 speakers. Sadly, William Dillon has fallen ill this morning, so we're missing that one, but that still leaves us 3 speakers, details of which are on your thing, but I'll introduce them as we go to save time and move on that basis. So the purpose of the session today is to look at the way that the banking lobby has influenced the debate and public policy around banking. We know some basic facts about 50% of Conservative Party donations come from hedge funds and other city lobbyists. That a statistic I didn't know beforehand. There are 700 lobbyists, financial lobbyists in Brussels alone. I just try to picture these 700 people wandering around Brussels doing what isn't very clear. But obviously that's some of the issues, plus issues that were trailed this morning by Catherine, for example, that Sarah's going to touch upon, the Robin Hood tax and issues like that. So essentially we're going to ask each of the 3 speakers to talk for about 10 minutes each, pitch their particular angle on the issue, and then I'll open it up for discussion more broadly around the issue. And we have our beautiful scribe, Stephen, who is going to summarise some of those points for us, and obviously produce something for us as part of the conference report. So that's the game plan for today. So I'm going to kick off by asking Greg Ford, who is the Head of Communications of Finance Watch, which is the public interest advocacy group, and he's a financial journalist and blogger on financial matters. And ask Greg if you'll give me a question. Right? Okay. Yeah, you just got it. Just a bit of ice, yeah. Just nice.
So good afternoon, everybody. My name is Greg Ford. I'm Head of Communications for Finance Watch. As Dave said, Finance Watch is a public interest advocacy organisation based in Brussels. We were set up initially as a counter lobby to the financial lobby. I'm going to talk about the lobbying scene in Brussels, then say a word or 2 about what Finance Watch does, and then I'll just conclude with a few thoughts on what civil society can do to fight back. So just to try and paint a picture for you about what the lobbying scene in Brussels consists of, who is it that's actually being lobbied? Well, in Brussels, which produces most of our financial law, the main institutions, the Commission, Parliament and Council, between them produce our rules. The Commission drafts legislative texts, and then the Parliament and the Council negotiate before agreeing and then adopting the texts. So that's where most of the lobbying gets focused. It's rather interesting that something like 90% of financial lobbying, by our reckoning, is directed at the Council and at the Commission, the 2 least democratically accountable institutions, and the rest is dedicated to the European Parliament. There is a lobby register in Brussels, which is very effective. Something like 99% of lobbyists are signed onto it, and this includes behind-the-scenes lobbyists such as law firms, consultancies, and researchers, who we can refer to as the munitions workers for the lobbying army. They're all on the register. So who are these people? Well, they fall into roughly 4 categories. Trade associations are the most obvious ones, and in my view the most legitimate. These are bodies that represent their industry. Just to put this in context, every industry grouping tends to organise itself along these lines. In the construction industry, for example, there are more than 30 different trade associations purely for construction, for building supply materials and so on. There's even a trade association for construction trade associations. Finance is no different. The main associations here are the European Banking Federation, the insurance, the exchanges, and different trading groups. We've had some recent additions, such as the Principal Traders Association, I forget the exact name, which represents high-frequency traders, very popular at the moment. And there are a few acronyms that you may recognise up there. Next in line are the public affairs consultancies, and there are probably 5 or 6 big firms who employ individuals that are real dyed-in-the-wool Brusselites. They probably speak 4 languages, they're probably married to someone that works in the European Commission, they probably worked in the European Parliament or the Commission themselves. They'll work as like lawyers, charging by the hour for up to a dozen or 2 dozen large financial firms. Some of the best known, bigger names are up there. Then we've got the in-house public affairs teams. Big banks, big insurance firms, all big financial institutions have their in-house teams. Different from PR, different from marketing. These public affairs people are the ones who are the eyes and ears of the industry, of the firms in government. There's no real pattern to this. Now, for example, if you look in Brussels, there's a full-time staff of about 4 representing Barclays in Brussels. But then other banks, such as the Italian bank in Intesa Sanpaolo, is a team of 7. HSBC and Goldman Sachs don't have any, although their public affairs teams in London are forced to be reckoned with. I don't know how many others. I know that ABN AMRO used to have 15. I think they staffed up during the time of the merger. Those are the in-house public affairs teams. And then finally, the forgotten army of people behind the scenes who make the bullets. These are the law firms who go over the draft legislation, they find the loopholes, they work out how to get around them. The big 4, the accountancy firms, management consultancies, and industry-funded research institutes, which is a very broad term, which I would say includes pretty well any research output that could be business schools, for example, or even university departments, that is partially, or in some cases, wholly funded by the industry itself. Much more subtle. How many? Well, we estimate 200 to 300 full-time lobbyists physically based in Brussels, and if you gross it up over the whole of Europe, about 700, with a pretty large budget to match. So now the interesting part, how do you lobby? What is lobbying? And so I thought I'd just speak a bit about some lobbying techniques. I should mention, this is all second-hand. I've never done any of these things. No people have been harmed in the preparation of this presentation, at least not by me anyway. But so I'm told, one of the biggest selling products for the public affairs consultancies is thought leadership, which sounds like a very grand title, but what it refers to is establishing a client, or more likely an individual within that client, as a global expert on a particular topic. I think this is a little akin to Cold War espionage and having sleepers placed in Moscow or Washington. These are people who will be building up their reputation over many years, not showing their cards, and then, when the legislation comes, they're the people that get the phone call from officials grappling with new technicalities for the first time, because they're the experts. That's when the cards start to be played, and it happens years in advance. We see the evidence of this in setting the framework, as I put it there. What I'm referring to is establishing principles on which all financial regulation can run, such as, for example, that ETFs or absolute return investment products can be considered to be investments. In the purest sense of the term, an absolute return product is not an investment. It's not about bringing money to productive use. It's about betting on the direction of the price. That simple distinction has been completely and utterly lost, and you'll find that most of the regulation relating to retail investment products coming out of Brussels now, UCITS, PRIPS, and so on, conflates the two. Some of the distinctions arise around differences between liquidity and volume, which are different things, but the industry winningly confuses them, and so on. The next thing on the list there is capture by complexity. With finance, it's not that difficult. At the most basic level, you can simply say to a regulator, well, you don't understand, we do, let us make rules. Better still, don't regulate us at all. And we've seen quite a lot of that. More sophisticated and perhaps more realistic nowadays is the distraction technique, where the industry will deliberately focus on one specific area of a market, such as naked shorting in the CDS industry, or aspects of calibrating risk capital in bank capital rules. And the regulators will focus on that and miss the bigger picture completely. A lot of the individuals who work in regulators are essentially geeks, and they like nothing better than to be challenged by hardcore technical stuff. If you read through the Basel documents, you'll find pages of differential calculus, and this is about deciding whether a bank should have 1.2% capital or 1.23% capital. Actually, the bigger picture is should they have 10% capital, but regulators are not seeing it. Some of these other techniques really speak for themselves. I'll just say a word about political pressure points. If in a lobby meeting, you're meeting, for example, a left wing or a socialist, or even in the European Parliament, a communist representative, of course you're going to talk about jobs. And it's amazing how many financial reforms either create or destroy jobs and you listen to. If you're speaking to somebody in the other end of the spectrum, at the EPP, you'll find that the arguments tend to relate to efficiency and freedom. And then finally, a very important topic of revolving doors and social contacts. Befriending officials at junior levels, and there's quite a lot more than the friending goes on, so I'm told. Revolving doors, moving from the industry into regulation and back again can be extremely lucrative. But some of the arguments that the Brussels lobby is particularly keen on are the international competitiveness argument, otherwise known as the level playing field. This is where you say to Dodd-Frank lawmakers in the US, don't possibly introduce Dodd-Frank because all your banks will relocate to Europe. And then you come up to Brussels and you say, don't possibly introduce CRD because all your banks will relocate to America. Obviously they can't both be right. They're all going to Asia. So now we've got the single market pressure point. This is particularly favoured by European Commission officials. The head financial regulator in Europe, Michel Barnier, is responsible for the single market. If you can demonstrate to him, for example, that the Vickers Commission reforms would put the UK at a competitive advantage over other countries and destroy the single market, you can persuade the top financial regulator in Europe not to allow Britain to regulate its banks more harshly than other member states. And that's exactly what's happening with maximum harmonisation of bank capital. Employment and growth, we've seen this argument used and abused in the FTT debate. I won't say any more about this now because I hope we'll come back to that later on, but there are some fantastic examples of abuse of statistics there. And then finally, really common efficiency. So now just a word about Finance Watch. Finance Watch was created in 2011. I think we're going to have our first birthday next week. The background to this is the Pittsburgh Summit of 2009 unleashed an enormous legislative agenda that's being implemented by Michel Barnier, who took office as the European Commissioner for the Internal Market and Services in 2010. The result was that financial lobbying went ballistic. When the hedge fund directive was making its way through Brussels a couple of years ago, the rapporteur in the Parliament, who was a Conservative MEP, had 198 meetings with hedge fund representatives and not a single meeting with anybody else. And he was so exasperated that he signed on to what by then was a little document circulating around Brussels called A Call for a Finance Watch. This document ended up being signed by more than 200 elected officials around Europe. And the call essentially was a call to arms saying we need to create a counter expertise body that will speak for the public interest in financial regulation. We've now got 54 members. Next week we'll be announcing another 20. 7 staff, soon to double, and growing online following as well. So today we call ourselves a public interest advocacy group. Our mission is to make finance serve society. We do this by supporting our members, who are mostly civil society organisations, such as Friends of the Earth, to help with their own advocacy. We also seek to explain financial reforms to the general public and to our friends. So, for example, if you're interested in Basel III and you want to know what bank capital is all about, you'll find on our website a cartoon version of Basel III, which I believe is the first in Basel III. We're trying to explain it and demystify it as best we can. Next week we're issuing a report on commodity trading and high frequency trading called Investing Not Betting. And if you're interested, I urge you to download it and have a look. We fiercely guard our independence, both from funding and political interference. And unfortunately, the missing chair today, William Deenan, is in fact one of the members of our Committee for Transparency and Independence. So those are the dossiers we're working on at the moment. We also follow a number of proactive themes which cut across several different legislative packages, such as too big to fail, and investing, not betting. And the way that we operate, in a way, is a mirror image of what the financial lobby does. We engage directly with the EU institutions, all three of them. We respond to consultations, we write position papers. One of our position papers is here. If you'd like a copy, come and help yourself. We give evidence to legislative committees in Parliament and elsewhere, and we have meetings with policymakers. Now, we also brief our members on what's happening in Brussels, and we arrange workshops for them on new legislation to help them with their own responses. And we do a lot of press and media work, particularly on the continent. So, now to the bit that concerns you, and my key message for today is this: speak up. That's the biggest thing civil society can do. Financial lobby has got a huge voice. Civil society could have a huge voice. If you put yourself in the shoes of a commission official going through consultation responses, you've got an in-tray with a stack of 100 documents, 99 of them are from the financial industry. One is from civil society. It's going to get a lot more attention. It has scarcity value. And it doesn't matter if it's not as technically refined. It doesn't matter if it's not as perfectly supported by data as those who actually work in the industry. Of course it's not. But if you speak up and defend the public interest in that, then the voice will be heard. So you can respond to consultations, work with other groups, and enjoy Finance Watch. A few more things that civil society can do. It's important, I think, that when civil society organisations are responding, they really take the time to understand the arguments that the financial lobby is making and the counter-argument. And one of my biggest criticisms of the Robin Hood campaign, of which I'm a big fan, is that they made a big tactical error by focusing on what would happen with the proceeds of the tax. Whereas the financial industry has very successfully lobbied against the FTT on the basis that it would destroy jobs, which is a very vulnerable argument, but not one that the campaign has really devoted enough attention, in my view, to spiking. You can link finance to other policy work. Friends of the Earth is particularly good at this and has been doing some sterling work on linking capital weighting for bank capital requirements to sustainability and other issues. This is an idea that a couple of years ago was considered heresy. It's now beginning to appear in the shadow minutes of the FPC. We're seeing it in the Capital Requirements Directive. Even Basel is beginning to talk about it. A couple of years from now, it could actually be mainstream, and that's down to this kind of lobbying, so keep that cross-linking going. In terms of lobbying, a lot of our laws do come out of Brussels, so lobby MEPs. The MEP for Scotland is Alan Smith, MEP for London is Syed Kamal. These guys should be getting letters from us frequently. And UK ministers, George Osborne represents the UK, but the whole Treasury, they represent us on the Council, and it's the Council that pulls the plug on a lot of the most progressive reforms in practice. You can conduct independent research. Some organisations, New Economics Foundation has published some excellent reports. And finally, use your press contacts as much as possible to keep financial reform in the news. So that's my message.
Okay, thanks Greg. And moving on to our next speaker, which is Willie Sullivan. Willie's a man of many hats, but in particular the Vice Chair of Compass and the Scottish Director of the Electoral Reform Society.
Thanks, Dave. I'll tell you about Compass has kind of been mainly London-based, and hopefully there will be some more stuff in Scotland. But we in Compass believe that it's about just don't ask for change. We want to try and create the conditions where change will come about. So I guess what I'm going to talk about is a little bit of analysis of the conditions as they are, and then some ideas about how we might create conditions that are more conducive to change. So I think, all this discussion comes about because of the crash and what happened to the banks in the end of the last decade. And I think before the crash, it was assumed there was little need for transparency in the way that banks operated. The fact that they neither collapsed and brought our economy with them has kind of changed that a little bit from people like us, but I don't think it's changed that much in the views of bankers and politicians. And why is transparency important? I think it's important because people need to be held for account to their actions, and they need to know that they're being watched and seen, and when they're making decisions, that people can see that, and then they're more likely to make moral decisions, and they're more likely to make decisions that are not damaging. I think that transparency in a banking sector, a lack of transparency in a banking sector is incentivised, it's systemic, and it's self-perpetuating. And I want to address 3 areas to kind of demonstrate that. The first is the cultural and political context in which we operate at the moment. The second will be about issues of complexity, and the third is the subversion of our democracy. So, on the cultural and political context, I think we can only understand the financial crisis if we understand the political context and the cultural context in which it happened. Why were people able to make to take such damaging behaviour? Why couldn't it be predicted or prevented? And why, why did nobody question it? Why was it not challenged? I think banks and the financial sector are clearly constructs of our society. And while Friedman claimed that markets were naturally occurring like the wind and the rain, and the Goldman Sachs CEO Lloyd Blackburn convinced himself he was doing God's work, I think we can all agree that they're man-made, and they are mostly man-made. So if they're products of our culture, and I think the deal-making and big investment banks are kind of a zenith of a set of ideals and values that have risen to dominate our culture in the last 30 years. These ideas hang together neatly, but not too neatly actually, not exactly in an idea called neoliberalism. And I would assert that this is a political project. It's a political project that can be traced from Hayek, through Milton Friedman in the Chicago School, through Keith Joseph, Margaret Thatcher, and as Stuart Hall brilliantly explained in a recent article in Sidon's Journal, through New Labour as well. There's been lots of attempts to describe this set of ideas, and I've not really got a lot of time to do it here, but I think I'll pick 3 principles that summarise them. One is the self-correcting nature of the markets. The second is the inefficiency and the threat to liberty posed by a state. And the third is the preeminence of the individual in a social context of status awarded through wealth and power. Now, these ideals and principles are genuinely held by some people, I have no doubt about that, and of course are partially true in partial sets of circumstances. But I think whether you're a Marxist or whether you're a neoliberal, when you think you've got the truth, the whole truth about how society and economics works, then you're being deluded. You're deluding yourself. And I think part of the problem is this kind of delusion. And I think Anne Pettifer spoke about this earlier today as well, and others have. When these set of ideas become hegemonic, when they become the received wisdom, when there is no alternative, then we can see why these behaviours become unchallengeable. They're a priori rights. And I think you have to waken up, and I think most of us here are, but I think you have to understand how we can get the wider political and class and the wider society to waken up to the idea, because you can see why they become hegemonic, that these decisions are not questions. And until we can kind of change that culture, then these things are much more likely to happen again. And that means events like this, where orthodoxies are challenged, where and I'll speak more about this in a minute, where countervailing forces are allowed to develop and countervailing ideas. So, as we've touched on, one of the other barriers to being able to see what's going on inside these institutions and challenge people and question them is complexity. It clearly is the enemy of transparency. And the complexity in our banking system and the way that some of these things are explained is astounding. And I would argue that size is a huge part of that. Because as banks grew, they diversified, but only internally, so they become huge, complex organisations, individual organisations, and they operate over huge areas, over huge geographies, so they're hard to keep a track on. And while there was diversity within the organisations, the diversity out with them, the types and numbers of organisations was reduced, and therefore you limit competition and choice outside of it. So if you're a manager of a bank, it's quite difficult to know what's going on in your organisation. If you're a regulator, it's virtually impossible. I mean, this came about through stuff like the mass marketing of retail products, bank assurance, securitisation, all these things that we know. Real transparency on those sort of organisations, I think, is impossible. It just can't be done. And whether this is still going on, and I'm sure it is, this is kind of compounded by deceit, misinformation, and a huge imbalance in knowledge of those within the organisation and those out with the organisation. And I guess one of the worrying things for us is that the organisations that are supposed to audit the banks were as complicit as anything else. And as most of you know, all the banks before the crash were given unqualified accounts. Now, I think for me that paints a picture of a huge threat to the public interest. And the problem being that those that are supposed to represent the public interest are supposed to challenge that, not only didn't do it, but were complicit in removing the safeguards that were supposed to do it. They're public servants, politicians and civil servants. And I think this is no less than a subversion of our democracy, that what we're talking about, Greg was talking about, is the way that they operate in Brussels, and I know they operate in the same in London, and to a lesser extent probably in Edinburgh. And we know this is still going on. The banks were too big, too risky, too complex and too free, and then we have the government doing far too little. And that to me just illustrates that the pressures that were applied on public servants and on the politicians before the crash, which led to the crash, are still being applied now to make sure that those changes don't occur. And so how do they do it? It's a kind of love-hate relationship, good cop, bad cop. On the one hand, they overplay their economic importance to the UK, threaten to take their jobs away, although the number of jobs that are actually created are significant, but not as great as you might believe when you hear them speaking about it. And the threat to move, Andrew Haldane of the Bank of England reckoned that the top 5 banks get 50 billion in subsidy, probably more than that now, through cheap government underwritten borrowing. I mean, most countries cannot afford or will not give that sort of subsidy to their banks. So these threats are certainly well overplayed. On the other hand, on the metaphorical fist that has love on it, I think they give millions and millions of pounds to the political parties. And endless briefings, policy advice to civil servants, to the media about what is the best thing to do for the British economy. So when it comes to balancing the national interest against the interests of the bank and the executives, I think it's, I think we've had this discussion today. I've read, lots of papers from NEF, from Compass, from others about what needs to be done. I've heard politicians speak about what needs to be done. And to me, while it might be difficult, it doesn't seem to, the arguments seem to be there. It seems to be obvious what has to happen. I mean, the banks have to be broken up, they have to be made smaller. Ownership has to be democratised, whether that be through mutualisation or even greater shareholder power. Bankers have to be paid less because they're incentivised to take risk, and there's huge social damage from that inequality of reward. Party funding has to be cleaned up, and they're starting to talk about it again, but the interests of the political parties do not rest and reside in cleaning up party funding. And I think until we get some sort of campaign to argue for public funding, then it's going to be difficult. And we need a register of lobbyists in the UK. There's the current government or coalition are proposing a register, but it's only for external lobbyists. You need in-house public affairs organisation or parts of the organisation to be registered and named. And I think we also need to know how much they're spending. That'd probably be one of the most useful things, to know how much public affairs is being spent on public affairs by the banks. And the things that the fact that these things aren't happening just shows to me that this set of interests still has a very significant grip on our society. If you like, the vampire squid is still sucking. And this stuff is all hugely important because it's about a set of values and beliefs. a set of values beliefs that led to a situation where the huge wealth inequalities were okay, that everything can be commodified and sold. We saw the commodification of the food futures being shown by Oxfam this morning, and a situation where scarcity means profit, even if that scarcity is our very planet. And I think one of the greatest problems of this is the only aspiration that we can get in a society that is constructed around that those sort of values and beliefs. The only aspiration that we seem to give people is an aspiration to get more stuff, and that's a real poverty of aspiration. And so what's the answer? I mean, the only answer I can come up with is democratic politics. There's no doubt the future will be different from the past, but whether it's a worse future or a better future is up to us and to our leaders. And I'm kind of concerned about that, because at this time of crisis, when we need our politics more than at any other time, politicians have given up on it. They don't seem to imagine a future that is much different from a little bit better today, and that's not really enough. Compass has written a lot about good society. We wrote a lot about it before the crash, and we're continuing to write about it in the terms being used a lot by different politicians. I've not got time to go into it here, but that for us is a planet, is a society where the planet is safe for our grandchildren, where the poor don't get poorer. In simple terms, that should be a set of objectives around which we design a financial system. Now we're going to see a little bit more about countervailing forces. The power and wealth of the people that have constructed the politics and culture which allow that financial sector to be developed needs to be balanced and challenged. So we need diversity, we need plurality, and we need outriders and thinking to be encouraged. That was traditional. I mean, when I go to Canary Wharf and look at Canary Wharf, and it's clear there's been a huge victory of the right, and these are the institutions of the right. These are the temples of the institutions of the right. Where are the countervailing forces? Where are the trade unions? Where are the public? Where's local government? Where's civil society? That needs to be developed. If we're to avoid this happening again, if we're to have any real influence, then those countervailing forces need to be developed and grown to check that balance. And I would just say to the masters of the universe is very big and you're very small, so I think we should act accordingly. Thanks very much.
Thanks very much, Willie. So we've had a bit about structures, had a bit about some of the big ideas and issues of transparency, and that leaves us to the case study, which is where Sarah's going to take us through the Robin Hood tax.
Okay, thank you. I'm just going to stay seated if that's okay with everyone, because I won't be able to read my notes standing up. Very small typeface. Yes, the Robin Hood tax we heard a little bit about this morning. So I'll just quickly recap on the background, but then go into the current situation for the Robin Hood tax, where we are now, and also deal with some of the questions that have come up over the course of the day about this tax. So in its technical language, it's a financial transaction tax, and the proposal is for a tax of 0.05% that would be on transactions of stocks, bonds, foreign currencies and derivatives. And if this was implemented globally, it could raise as much as £250 billion. This money, the purpose of the Robin Hood tax is that this money would be spent on ending poverty, both here in the UK and also overseas, dealing with poverty issues and with the impacts of climate change. And that's why the Robin Hood tax is a coalition of a lot of different organisations. There's international organisations such as Oxfam, Christian Aid involved. It's the trade movement the trade union movement are behind the tax as well, and lots of domestic poverty charities are backing the tax and looking for something like this progressive taxation to be put in place. So where are we? Where did this idea come from? It's an old economic idea, it's not a new idea, but the campaign for it has been around for the last 2 years. And it came about after the economic crisis, the note that there was a lot of public anger at the banking system, and that the people who were taking the brunt of the economic crisis were not the people who felt they caused the crisis, and they were also not the people who really benefited during the boom times either. So as the crisis continues and the crunch is really now starting to take hold on people in terms of jobs, and year-on-year bankers' bonuses continue to be announced, it continues to fuel the debate around the idea of a Robin Hood tax. But it wasn't just about public backing for such a campaign. It was also about looking for progressive taxation, for finding innovative ways to finance poverty reduction. And because at present the banks do occupy quite a unique position within our economy. They had the initial bailout during the crisis, but as we've also just heard, there's ongoing subsidies that the banks can take advantage of, being seen as too big to fail. And in 2010, that subsidy was around £46 billion. To put that comparatively for the UK and other countries, that was 62% higher than the similar subsidies in Germany, which has a larger economy. And perhaps some of the information we saw this morning about the difference in the banking system there can explain some of that. But it's also a sector that's very much under-taxed. For example, it's not, the financial services are exempt from VAT. So it's looking at a sector that perhaps some form of progressive taxation would be a good idea for now. Because it is a very profitable industry, 26 times more profitable than the average business. So that's the proposal of why a Robin Hood tax would be a good idea, why it came about now, and why it's an important time to get a tax in place. It's also a very, as I mentioned, it's a very popular campaign since it's been launched just over 2 years ago. Emails to politicians have been 180,000 emails to politicians in the UK. It's got a huge fan base on Facebook, Twitter followers, and there's been a real social media campaign as well to get people engaged and involved in that. In Scotland, we conducted a YouGov poll this time last year, so it's now slightly outdated, and there has been a lot more publicity, I would argue, for the Robin Hood tax, so possibly these are a downward estimation of what it would be now, but 62% of the Scots polled at that point backed the tax. 20% didn't know how they would answer that question, so either hadn't heard of the tax or weren't sure on whether to decide. So it was a small percentage that said they wouldn't support such a tax. So what is the position now in 2012? Over the course of last year, there was continuing successes in terms of support for a Robin Hood tax, for a financial transaction tax. We saw the campaign really taking off in Europe in terms of the support that was seen. Over 1,000 world economists have stated that they would back a Robin Hood tax, in particular that the money would go to the issues of poverty reduction and climate change. Religious leaders are backing the tax, but also European leaders are backing it. Sarkozy, Angela Merkel are key drivers within the European Union to take this tax forward. So despite fierce opposition from a lobbying in the financial sector, there's a really good chance that a coalition of 9 countries in Europe, led by Germany and France, and representing 90% of the Eurozone GDP, could push ahead and implement FTT this year. This in itself could raise 38 billion euros. So that's a significant movement in terms of getting a financial transaction tax in place. It's also very important, especially for the development organisations behind the tax, that its purpose is to eradicate poverty as well. And I know we maybe would take some criticism for having spent too much focus on that, but some of the leaders within Europe are also saying that it's not just a financial transaction tax, that the money would be spent in the ways we're talking about. There's also key leaders within economics and business have come out, and we heard about that this morning. Bill Gates supported it and was advocating for it last year at the G20 at the end of the year. Joseph Stiglitz, who's one of the economic advisors to the Scottish Government as well, is backing the tax. But there's support coming from some unusual suspects as well. And the research, I think, this year is helping to counteract some of the issues that we maybe haven't talked about enough as part of the Robin Hood tax. So Ernst and Young produced a report this year which made quite frightening reading for those who feel that a tax would be damaging for the UK. The Ernst and Young findings state that even if the UK opted out of a EU-wide FTT, they would still end up paying towards those transactions because so many of the transactions take place with countries in Europe. So while we would be exempt from making any revenue on an FTT, we'd be paying it to European financial partners as part of the transactions we did with them. So we'd be going into EU revenues, and that would be around £21 billion. If the UK joined, I hope this is making sense here, if the UK had been part of that tax, the full amount we'd end up paying would be £36 billion. So it's not a huge leap more to be paying that, yet we'd be getting a huge proportion of that back in revenues to our country, which would go to support public services and stop the cuts in public services, and could be used as part of the revenues to the UK Treasury. So that's an important aspect for the financial sector, to look at key findings that are coming out of some very respected institutions within organisations within that field of work. Also, Intelligence Capital produced some research about what the impact of a tax would be on the economy, and are now being able to use this sort of research to counter the argument that a tax would be so damaging on jobs. Because, as Greg mentioned, the banking lobby has been promoting views that the tax would dramatically impact on jobs around the UK, not just in the financial sector. They suggest that 500,000 jobs would be lost in the UK, despite the fact that where they're taking that statistic from was started from some evidence from the EU Commission that they themselves have reviewed and pushed much further down. So research that has been done by Intelligence Capital shows that not only could a tax not just have that negative effect, but it could actually have quite a positive effect on the economy. If the revenue was coming into the UK as well, it could be used to promote growth, and their findings suggest that the growth could be 0.25% in the economy as a long-term outcome of the tax. So the coalition is now trying to make sure we can promote those findings as well, so that it's clear that we're not just talking about something that would be nice to eradicate poverty, but there's strong economic sense behind that growth could come from this tax. But there are significant barriers, although there's just progress this year and over last year on who supports the tax. The significant barriers do lie in our own country, in the UK. David Cameron couldn't really be less objectionable to the Robin Hood tax. I'm not going to quote from him, but he has made it pretty strong what his feelings are on the issue. And George Osborne in Scotland, Danny Alexander as part of the Treasury as well. But it's the impact of this banking lobby, and just to give you a couple of quotes on how that's impacting, particularly on the Robin Hood tax. In the latest Dinners with Cameron scandal, some evidence showed up on the guest list for the dinners. At number 10 were at least 5 of the major city officials. Michael Spencer of the ICAP founder, reportedly had personal reassurances from David Cameron that he would block a Robin Hood tax that would affect his business. And Peter Krudos had also boasted that he used his own access to lobby David Cameron to veto plans for a financial transaction tax. So while evidence is coming out that the impact of the tax could have such positive economic findings as well, these key figures are speaking to David Cameron on a personal level and claiming that they have these personal reassurances. And that's something that we've really got to take on as a coalition campaign, but as all the supporters of the Robin Hood tax, to make sure that our voices can be heard, and that we make sure we're going to have a lot of voices to be heard, because we don't have the millions of pounds to go for dinner. In Scotland, what we are, as Catherine mentioned this morning, Alex Salmond has not yet come out in support of a Robin Hood tax. He also hasn't publicly stated objection to it. And so we're seeking that Scotland should back the Robin Hood tax. Let's try and UK government can be isolated even within the UK, not just within Europe. Wales has already come out in support of the tax, so let's make Scotland the next one. Oxfam are hosting a petition for the coalition to to show your support for Scotland backing a tax. You can find links to that on our website, but also to ask your MSP to sign up to the petition as well, because it's key for us that politicians share back this. So far, over 40 MSPs have signed up to a Scotland-backed Robin Hood tax, so it doesn't look like something that's too high an ambition for us to achieve in the very near future. So I would urge you, if you support the tax and want to take some action, that's something we can do in Scotland. There's also a variety of different stunts and actions that the Robin Hood Tax Coalition are involved in around the UK. And I've been asked to give a message that there's possibly some more research coming out in the next couple of weeks. So if anyone was London-based and wanting to get involved in some stunts, then please speak to me afterwards. And as I've said, what you can start doing in Scotland as well.
Okay, thanks so much indeed, Sarah. Plenty of food for thought from there, and some time for questions or comments. Good.
On the FTT tax campaign, is that something that, well, it might be that an FTT tax would actually slow down trading, because if someone's doing high-speed trading, they're going to be presumably trading every millisecond, literally placing orders and then possibly trades within fractions of a second. So it's going to become much less interesting for those guys to pursue their current approach to investment. Whereas maybe the FTT tax would actually help Scottish firms. I don't know what Owen said about that. In that generally they're buy and hold investors, so they don't, on the whole, believe in like churning their portfolios on quite the same basis as some of the London-based ones or the US ones.
Since you asked me, I'm Owen Kelly, by the way. Sorry I was late. I work at Scottish Financial Enterprise. We represent the financial services industry, so I am indeed, in a certain way, part of the banking lobby. So I thought I should come along. On the financial transaction tax, I think the industry as a whole is not in principle opposed to the idea, where I think the UK industry is as strongly opposed as if it's not done globally. Now, you may very well say, yes, isn't that just a clever lobbying way of making it happen? I would refute that, actually. And I think the evidence of Sweden's experience of a financial transaction tax, and indeed the Commission's own report, does show that you really hemorrhage the business if you allow your competitors to operate. And I think the estimate from the EU report was, the Commission's report was, some 90% of the transactions will just move to Switzerland and elsewhere. So if that displacement is going to occur, I think you have to ask, is it really achieving the objective? In terms of that specific question, I think you put your finger on really, as far as we see it anyway, the question is, what is the purpose of the tax? There is an argument that taxation can, as some economists have put it, sort of throw sand in the wheels of certain kinds of financial transactions because they're just sort of bad, that they're too fast, the finance industry moves ahead of the real economy, and you cannot properly align the activities of the financial services industry with the investment needs of the real economy. That's more of a policy question. That's more to do with, if you like, sort of, discouraging certain kinds of trading, which I think is what Ian's referring to, for a policy reason, which is that doesn't help in terms of the financial services industry serving the needs of the wider economy. On that particular question, I think that's a very open debate. I don't think the difficulty at the moment in terms of the FTT and the EU is that is not the argument that's being made. People are making an argument that you should impose this tax, some on the basis of a kind of Robin Hood type of idea, that you're taking money from the industry and then spending it on other things. So it's not a policy tool to control the industry and change the way it behaves. It's a way of taking revenue and then spending it on other things. I think that's questionable myself, because I think who's going to pay the tax? Okay, it would be gathered through financial services companies, but who's ultimately paying it? It would ultimately be paid by pension holders and other individuals who are providing the money in the first place. So I think one needs to be careful about who's the ultimate payer of the tax, and it's more likely it will be customers rather than sort of companies. So I'm not sure it is quite hitting the target in those Robin Hood terms. Going to just finally to Ian's specific point, would it in a way benefit Scotland? I think the bigger question for us is that question about the EU as an economic bloc. And if you then see the hemorrhaging of the business because we only have it in the EU, that's a bigger concern. I mean, yeah, it's an interesting point. Theoretically, Scottish businesses do not engage in the high-frequency trading.
Yeah.
So, theoretically, yeah, there's a theoretical possibility there, but I think at the moment that's outweighed by the risk of all the business just going to Switzerland.
I'm going to focus on the Robin Hood tax and take a few more contributions on that, and I'll bring feedback.
The Robin Hood tax perhaps could be applied to assist Craig in his efforts at Brussels to bring about some sensible reform in the banking system. That would be a very useful purpose and keep it within the industry, as our friend here is suggesting. However, I want to make a point that I find what we said very interesting about the volume of what's going on of lobbying. We know how much goes on in Westminster too. The democratic deficit, which is being held to ransom by the lobby. And they're looking at the size of the problem in Westminster and even the bigger size of the problem in Brussels. I would like just to tell you that there is a new Scottish political party called the Scottish Democratic Alliance, which has adopted the financial monetary policies which are being suggested here in this conference by practically every one of the speakers. The prohibition of the banks being allowed to create credit, lend it to each other, speculate in futures, and all that sort of thing which disrupts the real economy. Now, the whole idea is that this gives a focus for people who feel, as a lot of us do, that the banking regulation requires reform. It gives you a political focus where you can actually get your ideas ventilated and developed. It's called the Scottish Democratic Alliance. It holds for independence in Scotland primarily for that reason, because it sees Brussels and Washington and Westminster as being so absolutely stuck in the mud that they will never see any reform taken.
Okay, yeah.
Yeah, hi, Josh Ryan Collins from NEF. I'm sort of developing that point a bit, I suppose. I think one of the ways in which reforms are blocked is partially the banking sector keeping ideas off the agenda, and it's partially the sometimes quite reactive role of civil society in reacting to developments in the financial sector and trying to stop them, as opposed to a more proactive policy of engaging with alternative ways of going forward, as we've heard about today, and addressing deep-seated structural issues. I know that Finance Watch are engaging with academics to try and take that more proactive approach, but I wondered if panellists could think about those issues a little more, and how we engage a broader audience of new ideas to bring to ministers, as well as simply trying to regulate and react to problematic developments in finance.
Okay. I'll take some feedback on those points. Sarah, do you want to pick up on the Robin Hood tax points?
Yeah, I'll just pick up on a few of them. In terms of some of the short-term speculation issues that you mentioned and how cut down on some of them. For the Robin Hood tax, that would be seen as a positive thing. We would see in particular that if there was another crisis, because there would be a reduction in those high-frequency transactions, the impact of a crisis would be reduced. In terms of the other examples brought out in terms of Sweden's experience with a financial transaction tax, one of the issues that I have been brought up as a reason not to implement a financial transaction tax, especially at an EU-wide level, is that there were some significant flaws in the way that Sweden implemented its tax, and that led to a lot of business moving from Swedish brokers. And because the tax was only on Swedish residents, and it was a relatively high tax for this kind of thing, much higher than being proposed with the current financial transaction tax, it was quite easy for Swedish residents to divert their business through London brokers, still to purchase make the same purchases, and that was worth it for them because of the height of the tax and also the lack of restrictions on them doing that. So you can take learning from that experience and whatever's proposed in the next time to make sure those sort of loopholes don't exist, so that countries wouldn't have to have that very specific example from it. Also, in terms of the pensioners being hit by the tax, the key thing that would be hit by the tax is the short-term, high-frequency transactions. So they would be the kind of hedge fund money, would be the ones that really would take the hit from the impact of the tax, rather than the pension funds, which often make the long-term investments, and they would take a very, very small reduction in their transactions from the evidence that we found.
Just one final point. I mean, we already have a financial transaction tax in the UK, of course, which is stamp duty. As I understand it, that's now what the French and others are looking at, quite specifically in the UK stamp duty system, and whether making that something used more widely across the EU.
Great.
Yes, I can just pick up on that, and I'm glad that Owen has come and made these arguments about Sweden and about the Commission's own figures, because I think that illustrates one of the early points quite nicely. The Swedish,
you anticipated your argument on displacement.
As you said, the Swedish implementation is really not at all comparable with what's on the table for the FTT, and that's very clear from the impact assessment. Also, the figures that the European Commission came up with from a dynamic stochastic general equilibrium model. If anybody doesn't know what that is, I suggest you ask Steve Keenan. That produced on a set of assumptions that presumably excluded the existence of banks and money, that GDP would reduce by 0.53%, unemployment would fall by between 0.03 and 0.2%, that would result in the worst case scenario of 500 million job losses across Europe. This figure was reported by David Cameron as saying, 500,000 job losses, we can't afford that. In Denmark, the press reported it as having pro-rated it to their small population, 5,000 job losses in the bag already, vote against it. This is important because Denmark holds the presidency of the EU at the moment. These figures were reported as if the jobs had already been lost. In fact, they were based on a worst-case scenario from an economic model that Commissioner Semeta, the European Commissioner behind the FTT proposal, said later these figures had been misused, I quote directly from him, and he reproduced his impact assessment 2 months later. So those two arguments I think are a good illustration. The second one is that, the third one rather would be something that's been missing from the debate is the benefits of changing behaviour, and rather an criticism, in fact, for the Robin Hood campaign, which is that omitting to focus on the change in behaviour and the benefits that would create for savers by reducing churn and volatility in the markets is a major oversight. And I think that as far as the Scottish fund management industry is concerned, to even acknowledge that the FTT could be a bad thing for the Scottish industry is perhaps to confirm one's suspicion that there is too much churn for the benefit of underlying investors. So those are my comments on that. As far as your comment about the Scottish Democratic Alliance, very pleased to hear it. I'll definitely be looking it up. I would say that our experience in Brussels is not so much that these are unaccountable, captured, murky, evil individuals. These are people who actually do want to serve the public interest, and they're doing their best. But when they've got 200 people telling them this is going to sink the economy, and HSBC relocates to Asia and the British economy will be sunk, and they believe it, nobody presents the other side of the case. So my message is, speak up, and we can actually have some faith in democracy if we use it by speaking up. And to get back to Josh's points about proactive approaches, this is a debate that we have internally at Finance Watch all the time. Should we be focusing on the legislation that's just coming out of the legislative sausage factory now, or should we be trying to set the agenda in the future? And there are visionary thinkers, such as yourself and Richard Werner, who are setting the scene for a battle down the line. And at the moment, the question is, we need some concrete wins for the public interest now, and we need to engage in debates that might be worth having and possibly losing now. And I hate to admit it, but I think the FTT is one of those. Well, I think it has been lost. In fact, there was a story I read this morning which said that the financial lobby, I don't know if Rowan can confirm this, has now dropped the dossier and is focusing on VAT lobbying instead.
I think that probably is correct, but one thing I would say, and I'm interested in what you're saying on it, I mean, the finance minister of Luxembourg is on record as saying that FTT is not a good idea. I think it's a mistake to think that it is somehow a UK thing. There is more than a blocking minority within the member states against it. You're quite right, the UK has taken the sort of front seat because the city, and absolutely, let's argue about rebalancing, proportion and all the rest of it, but it is a big deal for the UK. But it is quite wrong to think that the UK is alone in opposing the FTT. A lot of the other member states, and Luxembourg have come out and said this, but others are still keeping behind it. They're happy for the UK to run with the argument, knowing that it's probably not going to actually hit the statute book in the long run, but not to use up political capital of their own in lobbying. So I think you're right. I think people are thinking that it's probably not going to happen now, but I don't think that's because people are thinking, oh, what a brilliant piece of lobbying. I think people are just recognising that the member states have come to what our industry would think is the right answer.
Do you know what the GDP of Luxembourg and the Commission on Financial Services?
What I do know is that it's very large, and I do know that they have a very big stake in the impact of the financial transaction tax. They do so much fund administration there. So,
okay,
well, very large.
Yeah, I'm sorry, but you sound like a lobbyist on the industry's interest, and I'm afraid that industry's interest are not the interest of my small business or the people I represent as a local councillor. And that's been quite apparent over the years, so I'm afraid I'm likely to go there than I am with you. And I think what Josh said, I think one of the problems in Dave's a trade unionist, so I can say this to Dave and to Oxfam actually, is that there's been a lot of dealing with the symptoms of policies and allowing the forces that represent the interests of the financial sector, that type of policies that set values, that set ideas to run free. And actually, the things that Oxfam and Unison want to achieve, they have to be much more strategic. They have to be as strategic as Owen and putting together these sort of arguments and backing organisations like NEF and organising in a way to counter a set of interests that are not our interests.
Right, one last round there, colleague back.
Yeah, I was a bit frightened that we might be even being distracted in this debate itself, whether the finance lobby is actually going to take over the debate here. I think that, in a sense, I want to come back to Will's point about the countervailing forces, and I think countervailing forces are the kind of rational debate, the rational argument. But I think we can also depend a little bit too much on the rational debate and the rational argument, because we've seen it can be distracted into kind of back alleys and things like that. And actually, the financial lobby is more interested in material benefit for us very small class. It's a project. It's a project of redistribution from the poor to the rich, and that's what the New Liberal project is essentially about. So I want to say, I'm very much in support of countervailing forces. It's about ideas and debate, but also there are other countervailing forces. And I want to say, how can they be joined up? Occupy was mentioned this morning. UK Uncut, coordinated trade union strikes is another very important part of the countervailing force. How do we also sort of broaden our side of the argument, if you like, so that it doesn't just get trapped in debates? Because the finance lobby is certainly using whatever muscle it has to back its position.
Other contributions? Yes.
Just to answer the financial lobbyist, I mean, I think the financial transaction tax, the fact that it's not going to be successful, actually underlines the power of the lobby, I'm afraid. I mean, the vast majority of people think a financial transaction tax makes complete sense. The only people who don't think it makes sense is the financial lobby, and the fact that you're going to be successful over the rest of us shows the power.
I mean, is it the tax itself that is that's caused this furore on behalf of the financial organisations, or is it because it's symbolic of a taking away of power? Because that little video that was shown, where it's a very small amount of money on each transaction, you wouldn't think it was that significant, really. Is it because it symbolises power being taken away?
Any other points we want to make? Chats? Okay. Sarah, do you want to come back on any of those?
I think on the symbolism point, I think that there is something within that. The fact that the financial sector is so concerned about such a small tax being implemented on them, that such a small tax could have such a hugely damaging effect on that sector, makes it seem like it's a very precarious sector to be hanging on such an edge that such a small tax would, when we as taxpayers can take a 2.5% increase in our VAT, and nobody seemed to listen to us that we didn't think that was a bad idea. So I think the points are right about the impact the financial lobby has on this as a tax. But I'm a campaigner, so I'm not willing at this point to look at it as something that is a campaign that's not going to happen. So I would still say it's a very important campaign to have our voices raised, and we've got to, as civil society, to be able to